Me today is R. Sivakumar, Head of Fixed Income at Axis Mutual Fund. Siva has got about 20 years plus of experience in the debt markets and has a front row seat to the evolving debt market as we speak today. Today, what we will try and achieve is to try and explain in a very lucid manner some of the concepts that may often be baffling for first-time investors. And hopefully with Siva's experience, we should get some of your questions answered on the debt markets. Hi, Siva. Good evening. And Siva, we'll also have a Q&A session in about 30 to 45 minutes. Yeah, over to you, Siva.
Thanks, Shane. Good afternoon to all of you. Thank you for joining in. This is the first time I'm doing a webinar of this sort, so it's going to be very interesting for me. Please do make this interactive, post your questions, and Shane and the team are standing by to read those questions. We will do that as we go into this session. The way we thought we would do this is essentially for me to sort of give a background into what is it to invest in debt markets, what are the different types of instruments, etc. And that's really what I want to do. But before I start, a fundamental question that I keep getting asked by everyone is that why should I invest in fixed income? Why should I invest in bond markets? At the end of the day, isn't it equities where you expect to make long-term return? Shane, can you go back to the first slide, please? So we did this study of markets over a long period of time, and in India, really speaking, the sort of post-liberalization. So that's from the, let's say the early 90s is when you have data on interest rates and bond markets. It's coincidental that around the same time is when the NSE started operation. So from about 1994, we actually have coincidental information or coterminous information in some sense of the Nifty and bond markets in India. ICICI Securities, which is one of the old primary dealers, started putting out an index of government bonds. So we now actually have about 25, 26 years plus of data on the performance of debt and equity over such a long period of time. And if you actually see that, Shane, to the next slide, please. And if you actually see that data over such a long period of time, what is really interesting is over the period 1994 to 2021, at the end of 2021, it's bond markets, specifically government bonds, which have actually done better than stocks over such a long period of time. In fact, it holds even if you look at the last 5 years, 10 years, or even over a 20-year period, you find that the returns from these two markets they're not actually very different. As you can see, it's not that they are very different from each other over such long periods of time. There are periods of time, and of course, when stock markets do exceptionally well, the last 1 year is an example of that very sharp up move in the markets. And you also have time periods when stocks don't do so well. So it's a bit of a catch up on both markets from time to time. But in reality, over very long periods of time, you find that the performance of both bond markets and stock markets are similar, and bond markets, in fact, in India, have done somewhat better. This can be quite surprising to most people who are investors, because you're tuned to think that it's equities which make you money or make you wealthy. So what I'm trying to what I hope you will take away at the end of the session, first of all, is an appreciation of why you should be in bond markets, which is the fact that it can actually give you long-term performance. And then also give you some idea about the kind of flavor of what constitutes the bond markets, what are the different types of instruments, what are the risks in this market, and how you should approach it. If I have done that, I think I've done a fairly good job of the day-to-day. So let's step into what is it that we are actually trying to achieve. Next slide, please. So if you look at who bond funds are for, typically this is the kind of a range of investors as we think about, right, from young to old. Ordinarily, it's assumed that the younger you are, the more risk appetite you have, and the more you must invest in equities. Makes sense at a level. And it also believes that the older you are, the more you should have money in relatively safe assets. But it doesn't mean that when you are in a particular age group or a particular type of risk profile, whether you are a safe or an experienced investor, etc., it doesn't mean that you should have 100% of your money in any one asset class. It's not to say that you must put 100% of your money in stocks. It's not to say that you must have 100% of your money in bonds. The important thing is it forms a part of everyone's portfolios. And naturally, when it comes to fixed income investing, some of the basic stuff everybody already has. You probably already have a bank FD. You probably have a PF account, which is substantially fixed income, and so on and so forth. So you do have some exposure, but the idea is to have a balance between the different asset classes in your portfolio. Go ahead, please. So if I can just summarize some of the critical points, and I don't want to make this a presentation where I read out every element in a slide, but I just talk about a couple of important and critical points when it comes to understanding how to make investments, especially when you look at such different asset classes such as debt and equity. Diversifying risk is the #1 reason why you want to be having different asset classes in your portfolio or have an asset allocation strategy. You find at different periods of time, different assets do well. So you have periods of time when equities are doing very well, periods of time when bonds are doing very well. Like I said, on average, it balances out. But the period of it over time, it balances out maybe very long, and over reasonable periods of time, let's say in a period of years rather than decades, you would like to have an asset allocation which manages this risk. Secondly, there is so much that we can do as fund managers or in the industry or through various products to ensure that the returns you get can actually be different from just investing in government bonds. As we saw the index performance, whether it is Nifty or G-Secs, that's just an index performance. It doesn't really tell you anything about how the funds or any investment strategy will perform. And I hope that we as an asset management firm and the industry can actually give you some very interesting outcomes, which may be different from just an index investing. The low correlation between different asset classes help you in your portfolio and also allows you, for example, to rebalance the portfolio so as to ensure that your risk is managed. That's downside risk, or in terms of averaging, etc. I'm sure many of you are familiar with such ideas such as rupee cost averaging and SIPs in equity. Similar ideas of portfolio rebalancing can actually work even when it comes to asset allocation. Lastly, of course, investing through long-term strategies is much more tax efficient than trying to invest in some of these asset classes on your own. Go ahead, please. Now, before we get too much into the different ideas of what are all the characteristics of bonds, etc., a moment as to what is exactly fixed income. This itself is, as a phrase, itself is sometimes confusing. Fixed income just means exactly that the income is fixed, as different from a stock where the dividends are not fixed. The dividends depend on the profits of the company. In fixed income, the returns or the coupon or the interest is determined at the time of issuance of the bond. So, for example, you could have a fixed income instrument like an FD, which let's say pays you 4% a year, which means you put 100 rupees now. At the end of 1 year, you get your 100 rupees back, but you also get 4 rupees interest. Right? So that 4 rupees is determined right at the beginning, and you don't have to wait till the end of the period to know what your returns will be. That's in essence what a fixed income instrument is. There's a wide variety of such fixed income instruments. The simplest ones are the ones such as fixed deposit. But you also have what's called a money market instruments, which are instruments issued for less than 1 year. You have really long-term debt. The government of India issues 30, 40 years plus government securities. Some banks issue perpetual debt, which is to say they don't have a maturity at all, just go on forever. So there are very different types of debt instruments, but they all have a single characteristic, which is that the interest or the basis of interest is known upfront. And that's really how it works. And just like, for example, if you have taken out a housing loan, you know that it's a floating rate of interest. Even in fixed income markets, you can have floating rate bonds where the rate of interest is not specified, but it depends on a certain formula. But even so, the formula is upfront disclosed, so we know exactly how it will evolve over a period of time. That's really what it is. And we've tried to put across different characteristics, but essentially you have money market instruments, bank bonds, corporate bonds, government securities, and there are a variety of such instruments out there. But common characteristics is that you know upfront what is the tenor, that is to say how long the bond is going to be in existence, what is the rate of interest, and That is what defines a fixed income instrument. Go ahead, please. We discussed this a little bit before, but I also want to take a moment to sort of look at certain myths and misconceptions of investing in fixed income securities. So first and foremost is, I'm a growth investor, I don't want it. I don't need it, I should say. As I said before, there is no evidence to suggest that equities will consistently outperform over your investment horizon. Your investment horizon could be, could be measured in a few years, and that might be your horizon, or it could be your saving for retirement, which could be in 20, 30 years, whatever it is. However long your horizon is, there is absolutely no guarantee that any one asset class will do better than the other. So it's important to have an asset allocation profile, which is to diversify across these asset classes. And fixed income can be a low volatile way of achieving your goals. So it's not that you expect the fixed income funds to outperform over long periods of time, but that it can give you a different risk profile, and it's important as part of your portfolio. Second is a question as always keeps having asked is, there's no risk in fixed income. That's not true. There is risk. We will discuss a little bit about what are these different types of risks. But it's important to understand that there is some risk, although very often risk in debt is much less than the risk in equities. As I mentioned before, equities returns come in the form of dividends. The dividends can fluctuate depending on the profits of the company. The interest rate on debt doesn't move as much. It's not to say that there are no risks, but it tends to be less. Typically, it tends to be a lot less than other asset classes. Lastly, one question which is related to mutual funds is, are debt mutual funds like FDs? Well, they are and they are not. The similarity is that they, like FDs, this is a form of investing in debt, right? Investing in a fixed income security. But the difference is that FDs are, in a sense, where the returns are guaranteed by the bank or the corporate where you have taken that FD. In a mutual fund, you don't get any guaranteed return, but you get a participation in the underlying returns generated by that fund. So in that sense, they are similar but different. In the sense, there is no guarantee, but the investments underlying are, at the end of the day, fixed income instruments, and therefore you expect to get a return linked to fixed income rates of return. The other difference, of course, is the way they are treated from a taxation perspective. FD interest is taxed every year in your hands, whereas in a mutual fund, if you hold for long term, which is in the current scenario beyond 3 years, then you get a preferential rate of tax in the form of long term capital gains tax. So a few differences, like I said, point of taxation is in the case of a FD is every year. In case of a mutual fund, it's when you redeem, so that you can defer it as long as you want to. The tax rate, instead of being your marginal slab rate, is a capital gains taxation with indexation. So potentially you could look at a significant saving on taxes. There is no guaranteed returns, or there is no guarantee on your capital. An FD effectively, well, you are taking the risk on the bank or the issuer of the FD. But basically, as long as that FD, as long as that issuer is solvent, your FD is protected. There are no guarantees in capital market instruments, including mutual funds. So there's something to keep in mind, that there are no guarantees on these rate of on the capital protection. So you must keep look at the risk when you're making an investment decision. Lastly, in terms of liquidity, this is well, I shouldn't say lastly, but liquidity is another very interesting difference. Certain FDs, typically bank FDs, give you an exit option. There might be some penalty on withdrawal. On mutual funds, again, you do get an exit in the form of open-ended funds, which have a daily NAV. You may again pay an exit load when you redeem. This just sort of brings me to 3 things that you must keep in mind when you are making an investment decision in debt. The first is safety. Understand the risks before you buy any fixed income instrument. The second is liquidity. So safety is really, what are the chances of me losing my capital or my money? Right? What are the chances? So we will discuss this a little later, but the idea is to understand what are the risks that can cause me to lose my money that I've invested. Liquidity is, can I get my money back when I want it? So there's a slight difference. It's a form of safety, but it's a very different form of safety. Safety is the absolute loss of capital, but liquidity is, can I get my money back when I want it? And last is returns, which is, what is the rate of return I expect to make on this instrument. This term SLR, safety liquidity returns, is very, very easy to remember. And please use it in that order. Understand what is the safety, understand what's the liquidity, and then ask the question, what is my expected return? And if you do that in that order, I think you will make a lot of very wise investment decisions, especially in fixed income markets. Go ahead, please. Now, let's get into a little bit of the weeds about what are bonds and what are the kind of structures that we see in bond markets. The first, as I discussed before, is the rate of interest. So the rate of interest is defined. It's called the coupon. This is a very archaic term, but it has persisted, as with so many other terms in the financial markets. In a sense, it is the interest rate that is paid out on the instrument. There are different types of coupons. For example, coupons that gets paid every month or every quarter, every half year, every year. There may be a fixed rate of return, or they could be linked to a certain benchmark or some other interest rate, etc. The date on which you get your money back. So you put in 100 rupees, I get 4% a year. At the end of 3 years, I get my money back, 100 rupees. That is the third year, year 3. That's your maturity date. That's when you get your money back. The time from day 1 to maturity is called the tenor. So these two are linked, the maturity date and the tenor. The quality of the instrument is judged by what's called a credit rating or a credit risk. And credit rating essentially is issued by a third-party rating agency who judges, in their opinion, what is the risk of this instrument. The rating scale goes with the AAA kind of at the top, AA is coming next, single A coming next, and triple B thereafter. These 4 grades, AAA, AA, single A, and triple B, are what's called investment grade. And then you go into what's called speculative grade, often in the literature called junk bonds, which is here, which is double B, single B, triple C, double C, and so on. So the grades which are the more the A's you have in your bond, the better it is. Essentially 3 A's, so AAA is the top quality. So when you make an investment in a bond, what you know are the coupon and the tenor or the maturity date. And most bonds also carry a credit rating. This is what you know when you're buying a fixed income instrument. Go ahead, please. One very important thing to understand is the inverse relationship between interest rate or yield and the price of a bond. You see the graphic on the right, you see a seesaw. On the left hand side is the yield or the rate of interest, and on the right hand side is the price. And what you see is it's just like a seesaw. If the yield moves up and down, the price goes down or up in the opposite direction. So with a rising interest rate environment, the price of a bond falls, and in a falling interest rate environment, the price of the bond rises. This is sometimes counterintuitive. So I'm going to take a moment and explain why this happens. So for example, take a very, very simple example. If I have purchased a bond which gives me 10% rate of return, so which means if I put 100 rupees in this bond, at the end of 1 year, I'm going to get my 100 rupees back and another 10 rupees as interest. So 110 back at the end of 1 year. Now, let's say tomorrow, the rate of interest offered by that same issuer jumps to 11%, which means if you've now bought a new bond with your 100 rupees, at the end of 1 year, you will get your 100 back and then you will get 11 back. So what that means is that the older bond, which had 110 rupees of payments, is worth less than the new bond, which has 111 rupees of payment. The old bond is now worth about 1 rupee less. So the price of that bond actually falls to compensate for this rise in the yield in the market. So in essence, there is an inverse relationship between yield and price, and this is something which is sort of embedded, and we mathematically link these two with a concept known as modified duration. And modified duration is very closely linked to the tenor of the bond, which is to say that the longer the bond, the more is the modified duration of that instrument. And if you think about it in the same seesaw analogy, as you can see on one side, the yield moving up and down, on the price side also moves up and down. But imagine if the seesaw on the price leg was a lot longer, you will see that the movement of the price is significantly more for the same movement of the yield. So further away from the fulcrum, the movement is significantly more. So the duration, in a sense, is that length of that seesaw. And the longer the duration of the bond, the more the volatility or the price movement of that bond will be. So here's an example. If you look at on the left-hand side, you see the yield movements. The yield movements remain the same. But as you can see on the right-hand side, the shorter duration bond, which is closer to the fulcrum, the movement will be less. And the longer duration bond, which is on the far side, further away from the fulcrum, will see a larger movement. So if you imagine a seesaw, you can easily understand that if you're closer to the center of the seesaw, you move less, and if you're sitting further at the end of the seesaw, you move a lot more. So this relationship is called duration. The relationship between changes in yield or interest rate and price, and this is always inverse. So when you have yields go up, the price goes down, and when the yield goes down, the price goes up. This relationship is also known as the interest rate risk. So the variability of interest rates, as market interest rates go up and down, bond prices also go up and down, or down and up, I should say. And that relationship is known as interest rate risk, because the risk is essentially the risk of change in the interest rate in the economy. So as the Reserve Bank of India, for example, who sets the benchmark interest rates for the economy, if they increase or decrease the interest rate, there is a corresponding a decrease or increase in bond yields which happens in the market. Go ahead, please. Also take a moment to understand some of the key risks that exist in when you make investments in bond markets. As I discussed the interest rate risk just now, which is the volatility of the bond price. That is, your value of your investments will go up and down depending on the movement of interest rates in the economy. Now, when we are looking at mutual funds, we follow a concept of marking to market, whether it's equity, bonds, whichever. The fund's NAV reflects the current price of the bonds or the stocks or anything else that we own. But if you're invested in an FD, for example, mentally you don't count that as part of your volatile debt portfolio. But in reality, it's the same way that works. If, for example, you put money in an FD at, let's say, when the FD interest rate was 4%, and today, let's say the bank increases the interest rate and offers a new FD at, let's say, 5%, then there is an opportunity cost, that your old FD is now only going to earn you for, just because our bank has increased the interest rate, they're not going to pay you anymore. So there is a opportunity cost. That is the same thing. It's the same thing. That it's just that since the FDs are not, there's no price of an FD, you don't see it as a volatility. But that's essentially the interest rate risk. The risk that interest rates will rise after you have made your investment decision. The second is credit risk. The credit risk is, well, will I get my money back? In a sense, will the entity to whom I have lent go bankrupt and not be able to repay me? And this risk is essentially, it's not like, as we discussed in the case of price risk, prices move up and down by maybe a few paisa or a few rupees. But credit risk is where you stand to lose the entire principal. You put 100 rupees into a bond and nothing comes back or substantially gets written off. That's a credit risk. And as I mentioned before, one way of analyzing what credit risk is by looking at the credit rating. So the credit rating agencies essentially look at credit risk and they tag the bonds in a sense by saying that this is a high quality or highest quality and so on, and different grades. This is the risk of liquidity risk. As I mentioned, liquidity risk is, can I get my money back when I want it, even if it is premature? In the case of FDs, you look at this as a way, what is the cost of prematurely exiting that FD? Maybe you pay a penalty to exit. In the case of bond markets, can I sell this bond in the market? And bonds trade like stocks in the sense. You don't need to hold the bonds all the way to maturity. And so what is the risk that I cannot exit this bond before? There are a couple of smaller risks such as prepayment risk and inflation risk. If you have any questions on this, I'll get back to that. But otherwise, I'm not going to keep going back into it. But the critical three risks are interest rate risk, credit risk, and liquidity risk. Right. So now moving on from understanding the characteristics of fixed income securities or instruments, understanding what are the critical risks. Can we look at debt mutual funds with that lens to understand what is it, how do I evaluate what my debt fund is doing. So first and foremost, look at the critical risks. Understand the portfolio. Understand the portfolio duration, which is a measure of interest rate risk. Understand the portfolio um, credit quality. Typically, many mutual funds are rated, but even if the funds are not rated, the funds will disclose their portfolio, which will give you a sense of what is the credit quality of their own investments. Second, you can look at granularity of the portfolio to understand, is this portfolio diversified or concentrated? I'm sure diversification is well understood for many investors from a stock perspective. Holding a large basket of stocks is less volatile than holding very few stocks. Much of the same thing applies in bonds. Having a granular or highly diversified portfolio is less risky than a concentrated portfolio. Third, look at the AMC's investment process, history, and track record of over the years. How they have, built their team, what are the team capabilities, and how their products have done over the years. Fourth is look at how these risks that we have looked at in terms of the credit risk, the interest rate risk, have panned out in terms of the returns. So risk versus return analysis. And lastly, also look at who the fund manager is, what the fund manager experience and expertise and pedigree, how it panned out. One extremely important point in this slide is do not just go on the basis of historical performance. This applies to all debt products. I'll take a moment to explain why. As I mentioned before, when you have an interest rate cycle, when interest rates go down and go up, if you have a period of falling interest rates, as we have had, for example, in the last 3 years in India, the rate of interest on government bonds 3 years ago was well above 8%. Today, the rate of interest on government bonds is just a little over 6%. So we've had a significant fall in interest rate on government bonds in the last 3 years. Consequently, the value of those government bonds have gone up a lot over the last 3 years. So consequently, when you look at the performance of bond funds today, they carry a lot of this historical high, those high yields of the past translating into high returns of today. Similarly, if you had actually gone back to 2018 and if you had seen the previous 2 years, from the end of 2016 to 2018, you had again seen the yields rise from around 6.25 to about 8%. So in 2018, if you had done the analysis on the basis of historical returns, you would have found that historical returns were quite sad because they were in a rising interest rate environment. But what was a better time to buy? Is it a better time to buy in 2018? Or was it a better time to buy in 2016? And again, in 2016, the past 2 or 3 years returns were very, very good. It was again a period of falling interest rates. The answer is, it is better to buy in 2018 than in 2016. Even though the returns in 2016 look better. Because the returns in 2016 were looking better because the past interest rates were coming down. But interest rate then started to go up. Similarly, from 2018 to 2020, as interest rates came down, the past performance looked very good. But that does not tell you anything about how interest rates will move from 2020 to, let's say, 22 or 23, the next period. So it's important that you don't get blinded by the past performance of bond funds. They always look good when rates are low, and they always look poor when rates are high. And yet, it's when rates are high, which is the best time to buy. And when rates are low, it's not the best time to buy. So don't get swayed by the past performance. And that's extremely, extremely important. If I leave no other message today than this, I would have done my job. Go ahead, please. I'll also take a couple of moments to discuss debt mutual funds from a perspective of the categories of different types of debt products that we have. It can be very daunting for someone who looks at a fact sheet of a mutual fund or looks at any website which does research into mutual funds. Looks at such a extreme wide nature of or list of instruments and types of securities types of mutual funds that exist. So we've just tried to categorize some of these funds into different buckets. So for example, there are certain funds such as a liquid fund, an overnight fund, or a money market fund, which are really suitable for investors who are looking for short duration. So let's say measured in days or weeks, maybe months. Essentially, I want to park this cash somewhere safe, not very volatile, short duration, high quality. These are all products which typically fit that bill. Then you move into longer term solutions where where we expect investors to stay for years, maybe 1 year, 3 years, but of course, for many of our investors, they stay for 5 years or longer. And these are funds which are in the categories such as a corporate bond fund, a short-term fund, a medium-term, or dynamic bond fund, credit risk fund, etc. So these are funds where they do take a little bit of higher risk in terms of duration or credit risk. In a way, the fund manager is trying to generate higher returns and risk by holding more amount of cash or cash-like assets, but they come with a little higher risk, and therefore they require a little higher holding period to see those returns get manifested. And then, of course, in the industry, we do have a lot of specialist products such as gilt funds and long bond funds, etc., which we really, the way I look at it is that these are products where, unless you really know why you're buying them, it's best not to buy. In a sense, best to invest in the categories where the risks are more understood, rather than look at these specialist products which carry significantly higher duration risks, and the volatility can be a lot more than what you may be prepared for. But basically, look at funds like ours and the industry do put out guides as to what kind of funds may be suitable for what kind of investment prices. Please look at all that when you're making an investment decision. It can look daunting at first, but please understand the duration and credit quality is a good measure to understand where to put these funds. Shorter duration funds for shorter term investments, and longer duration funds, let's say duration which measures in let's say between 1 year to let's say 3 or 4 years makes sense for longer term investments. Durations beyond 5 or 6 years, it requires a particular understanding of the kind of portfolio that you really want to get invested. So that requires a little bit more nuance when you're making that investment decision. That's really it from my part of the initial sort of, I was 30 to 40 minutes, which is what I was told. I think we have hit that mark. And so that also gives us a lot of time to take questions. Shane, fire away.
Yeah, Siva, that was really, I mean, that was quite comprehensive. And I think we've got a little more than 800 questions. So I'll do my best to try and cover as many as we possibly can. So a lot of the audience, Siva, has been asking us about, if it was one fund that you would select in today's market, which fund would that be? What type of fund would that be?
Right. So my answer is not going to be dependent on today's market, because what happens in the fund in terms of response to the market is for the fund manager to decide. So I will recommend, or I will suggest funds more because they suit the kind of investment risks which I think most investors will understand. So when you look at your portfolio, start first with a short duration portfolio. Short duration funds are typically funds, let's say, with less than 3 years duration. So that's where you want to start. There is one category which SEBI, which is the market regulator, has determined should have a duration between 1 to 3 years. That's a short-term fund. You could easily pick a short-term fund, which can be the base of any portfolio that you create. And then, if you really want to add some extra to your portfolio, look at a medium-term fund, which has got a little bit longer duration. Or if you want a higher yield, go for a credit risk fund, which has a higher yield. So the way to look at it is build a core portfolio around high-quality short-duration bonds, and then add on a little bit, maybe slightly longer duration if you want to capture that opportunity, which can cause longer bonds typically have a higher yield, or lower rated instruments, as lower rated bonds have also higher yield. So look at building a portfolio which is a core and a satellite in some sense. Build a core portfolio around short duration, high quality instruments, and build other instruments around it.
Right. And of late, a lot of people have been selling floating rate instruments. Could you explain what floating rate instruments are, and are they ideal for a rising rate environment?
A floating rate instrument is basically, yes, one where the coupon of the bond is changes with the underlying change in the interest rate environment. So what happens is that as the interest rates go up, the return from that bond rises. So this kind of negates or reduces one of the big risks in bonds, which is interest rate risk. Interest rate risk, as I mentioned earlier, as you have a rising interest rate environment, the bond prices fall because the old coupons are worth a lot less. But imagine if your coupons now start to also go up. That protects you from this rising interest rate environment. So when you have interest rates that go up, floating rate instruments are a good way to protect yourself. Having said that, floating rate instruments do not come with, it's not a panacea, it's not going to solve all of your problems. They tend to be a lot less liquid, and there are not as many of them. So it's very difficult to create a highly diversified portfolio. Yes, it is possible. So but it is going to be only a part of your portfolio. So when you look to build your own portfolio, consider floating rate instruments as part of your portfolio, because they have slightly different characteristics and less liquidity as compared to regular bonds. So understand that it is also a slightly different risk. But yes, it's an opportunity that presents itself when you have a rising interest rate environment.
Okay. Another one, Siddhant asks us a question. He asks us, the FI has influenced the equity markets quite a bit. Do they do the same for the debt markets?
Foreign investors are a very small percentage of Indian debt market. They constitute something like 2 or 3% of the total outstanding market cap. This is in sharp contrast to equities, where foreigners are a very large percentage of the floating stock. So, as a consequence, the direct impact of foreign investors on Indian bond markets is very, very small. Because they just imagine, if you're 2% of the market, you're not going to move the market as much as the local market, which is 98%. So, the Indian bond markets is very, very domestic. But it is not to say that there is no influence of foreign impact. This foreign impact onto Indian bonds comes from two sources. One is that interest rates globally do tend to have certain synchronization. So when you have, let's say, yields on US treasuries or UK gilts or European bonds go up, they are in sync. Typically, Indian bond yields also go up, and vice versa. When global bond yields are falling, Indian bond yields fall. This is because global macro cycles and inflation cycles and interest rate cycles are always getting synced with each other. So there is a kind of a global link from that perspective. So that's the first impact. The second impact is through the channel of the currency. When you have a lot of foreign investors, now here aggregating debt and equity investors who are buying and selling, then typically the rupee also reacts. If you have a lot of selling of foreign investors in Indian equity and debt, then the rupee can weaken, and that itself can cause Indian debt to underperform. And conversely, if there's a lot of inflows, that can cause Indian debt to rise in value. In the last year, for example, we saw just about the time of the lockdown when it happened, with a couple of months, we saw significant outflows from foreign investors in Indian debt. And in recent months, that a lot of those flows have returned also. But we have not seen a significant impact of either side on the markets.
Fair enough. So Jay asks us what should be the ideal allocation to debt, because he already has like a PPF or some fixed deposits. Is he required to add on as a separate asset class, or should he just invest in conjunction? What would you say?
Yeah. So I obviously cannot give an idea because I do not know the percentages. But assuming that you have a reasonably balanced, and I cannot tell you, as long as you have a reasonably balanced approach, if you were to look at various advices, people tell you need to have a 60-40 mix of equity and debt, or in some such advice. I'm sure your financial planners can help you with that. Then count your PPF and debt funds together when you're counting the debt part, so that you have a comprehensive exposure to debt rather than purely looking at it as a debt funds versus equity funds. So as long as you have a good mix, including both, so look at it in conjunction with your existing FDs, PPFs, etc., and you're fine.
So we've seen a lot of yields across the developed world harden quite materially over the last couple of weeks. Do the US markets play a role, or do the debt markets in the US play a role in the Indian markets?
Yes, they do. As I said, global macro and all these functions are increasingly getting integrated. As India gets more integrated with the rest of the world, many of the forces which are driving the US yields higher are also the same forces which are driving Indian yields higher. So, for example, in the US, there is expectation now that over the next 5 to 10 years, that the average inflation will rise above 2%. Now, 2% seems very, very low for our standards, but for their standards, where the last 10 years the average inflation has been about less than 1.5%, that's certainly a significant change in the expectation of inflation, which is causing bond yields to rise. And one of the underlying factors is the rise in commodity prices. So you have seen oil prices go up, you have seen other commodity prices go up. And much the same is applying to India. So we are also seeing the impact in terms of our petrol and diesel prices go up, other commodities go up, and inflation expectations rising, and bond yields rise. As I said, the underlying factors are the same. It's not, the cause effect is not from bond market to bond market, but the factors which are driving the US bond markets and Indian bond markets in this case are somewhat similar.
Yeah. Another question that comes often up in this list is basically about FMPs. There are a lot of people who invested in FMPs over the last 4 or 5 years who've made very, very good returns. Now, as they look to kind of redeploy that, how would you kind of position, which products would you position in this place? Because we don't have very many FMPs on offer today.
So the one of the things that we did study is the relative performance of open-ended funds versus FMPs. So there is this belief that FMPs are somewhat insulated from certain risks, right? Interest rate risk, liquidity risk, etc. So therefore, it should be a relatively easy way to invest. But what you actually see is that over the same holding periods, let's say an FMP you invest with at least a 3+ year holding period, right? From a taxation perspective. So if you have the same 3+ year holding period and you look at a performance of a short duration fund or a medium term fund, what you find is the outcomes are very similar. Maybe in fact it's better in an open-ended fund. So my suggestion is, please look at the open-ended fund category. They give you much better liquidity. So in case you do need your withdrawal to get access to your money before the 3 years are up or the term of the FMP is up, you have access in the open-ended. In other aspects, I would expect the open-ended to do similarly or better. And lastly, and which is very, very important, is that when you are in an FMP, and let's say you are in a 3-year FMP, at the end of 3 years, you have to buy, let's say you buy another FMP. Your capital gains meter once again starts from there, and you have to hold for another 3 years to get long-term capital gains advantage. If you are in an open-ended fund, the first time you cross 3 years, after that, every day your long-term capital gains starts. So after that, whether you hold for another month or whether another 3 years, another 10 years, doesn't matter. You are still in a long-term capital gains bracket. This is very important because you then can look at the returns risk profile without having to worry about, am I going to suffer tax because of this transaction? So I would say, please have a look at alternate similar quality, similar duration, open-ended funds, and I'm sure you'll have a good outcome.
And we also forget the power of indexation, right? I mean, indexation is a big pull Absolutely. As well.
Absolutely, Shane. I think the longer you hold, then yes, you do get that power of indexation work.
Yeah. A couple of months ago, perpetual bonds have really been flying off broker desks. What is your view on perpetual bonds?
Please understand the risk of a perpetual bond clearly when you're investing in perps. Now, perpetual bonds in this case, I'm assuming that you're referring to bank perpetual bonds, which are these known as additional tier 1 instruments. Now, we're getting a little bit complex. So those on this webinar who are in the 101 part of it, please plug your ears. You might need to, because this is a little bit more complex than other instruments. But let me do this because it's important. It's a very large segment of the bond markets over the last few years. And given that about a year ago, one of the large banks was asked by RBI to write off their additional tier 1 bonds. So there is a reason to understand this market before you enter in. Now, when you look at a bank's capital, it comprises of debt, senior debt, like for example, bonds or deposits. And then you have what's called subordinate debt, such as tier 2 bonds. And then you have what is called capital. Capital comprises of 2 components, equity capital and additional tier 1 capital. So which is to say that these perpetual bonds are actually sitting right next to equity capital. And the experience of last year's bond bank failure or a near bank failure, which led to a recapitalization, suggests that in fact the additional tier 1 bonds can be written off before capital gets a before equity takes a loss. So that is to say that under certain scenarios, the risk profile of these additional tier 1 bonds is even higher, or the seniority is even lower than equity. So there is a significant risk associated with investing in these additional tier 1 instruments, which is probably not well understood. But if you do understand that, and therefore you are taking an equity-like view of that bank, then certainly you could look at this as an interesting investment opportunity. But remember that unlike an equity instrument, you do not get upside participation. So when you're investing in equity of a bank, if the bank does well, you get an upside. If the bank does badly, you lose money in equity. In a perpetual debt instrument, if the bank does well, you get no upside because the coupon on the perpetual is the same. But if the bank does badly enough, you could lose money. So it's a little bit asymmetric. And because of that asymmetry, your yield is slightly higher than normal debt. So you are getting compensated to some extent for the risk that you're taking. So please understand this before investing in AT1. I'm not a big fan, if you ask me, of investing in AT1 bonds. Unless it's a very specific exposure to very specific banks where we have developed that comfort.
Yeah, I don't think we have too much of perpetual debt on our portfolios, right?
That's right, Shane. So the reason for that is exactly this: that it's an asymmetric risk, and we only choose to invest in those perpetual bonds where we have very, very strong confidence in the financials of that bank, and that it will not deteriorate significantly.
Now, let me pick your brain on a category that has been a hot favorite for us at Access, the banking and PSU category. How is this different from, say, a short-term fund or the corporate debt funds that are available in the markets? What is the unique characteristic of this type of bond? Why is it so popular?
To be honest, there isn't that much to choose, especially if your short-term fund also is biased towards high-quality bonds. So these categories are created by SEBI to target specific underlying characteristics of the paper. So, for example, a short-term fund as defined by SEBI has a fund duration between 1 and 3 years. A corporate bond fund does not have any such limit on duration, but it needs to be 80% plus invested in AAA or AA plus bonds, which means bonds of relatively high quality. So if your short-term fund also is, let's say, 80 or 90% in AAA bonds, then the difference between a short-term fund and a corporate bond fund is relatively small. A banking and PSU fund is further differentiated in the sense that it is primarily investing only in instruments issued by banks and public financial institutions. So this is basically, it's almost like a banking sector fund in the debt space, right? So yeah, and typically, since these public financial institutions are AAA rated, these are instruments such as the National Housing Bank or National Bank for Agricultural and Rural Development, NABARD, etc. These instruments are quasi-sovereign in nature. And the other public sector entities, so banking and public sector. So it's like it's a little broader than just public financial institutions, but. Yeah. But the essential idea is banking and PSU funds, banking and PSU debt funds should have the highest quality or perceived quality, at least in terms of credit. Other corporate bond funds should be near that, but could also include other AAA rated or AA plus rated corporates in the private sector. And short-term funds, while they do not have these specific restrictions, typically also tend to invest in similar bonds. So if you look at it, these three categories have a lot of overlap. And it shouldn't matter. Various mutual funds offer slightly different portfolios. So, for example, I can speak from a perspective of Access. Our banking and PSU fund is run more like a very, very passive, what's called a roll-down strategy, like an FMP. Its maturity reduces as time goes by. That kind of is a different investment strategy. It's called a roll-down strategy. Our short-term fund is just that. It's a short-term. It's a 1 to 3 year duration product. And our corporate bond fund, quality-wise, is also AAA, but it can go plus or minus of the short-term in its duration profile. So it's a little bit, think of it as a little bit more active short-term fund. So these three portfolios are biased towards quality. The differences aren't going to be too huge for most funds.
Yeah, we spoke about FMPs earlier. I think the banking and PSU fund is a good alternative, isn't it?
That's right. So an FMP is, in a sense, a closed-end roll-down strategy. What a roll-down means is that the maturity is fixed up front, And as time goes by, the tenor as we discussed before, is the difference between today and the maturity date. The tenor keeps reducing as you go towards the maturity. Much the same way in a roll down strategy, but in an open-ended fund, the average maturity is set at a particular date, so that as every month goes by, the tenor of the fund also comes down. So in a way, it mimics the characteristics of an FMP, but in an open-ended nature. And to answer the previous question, you could look at these kind of products as a proxy for your FMP investments also.
Yeah. A very important segment I think we've not spoken about too much is the credit space. So we've seen a lot of activity over the last 18, 24 months about why credits have been in the news for all the wrong reasons. What's your view on how investors should navigate credit markets and credit funds per se?
Yeah. So it's very it's sometimes, how time flies. ILFS was now nearly 3 years ago. It was in August, September of 2018, 2.5 years ago now. So in 2018, we were sitting on, when I was discussing interest rates, I discussed how interest rates were at an all-time high, or at least, let's say, the high for the last cycle. We had very tight liquidity environment. We had high interest rates, and the macro environment was deteriorating. We had the challenges still from the GST and demonetization weighing down on the economy. Macro headwinds, growth slowed down considerably, and we had tight monetary policy, which led to a lot of challenges for many NBFCs and other companies. So you've had that. But what has changed over the last 6 to 8 months is a lot of these policy environments have flipped around. Very low interest rates, very easy liquidity has actually made life very easy for many of these entities, many of the non-AAA entities. And also the macro environment has started actually turning positive. So now we are seeing sort of green shoots of recovery. A lot of the indicators which were looking really, really weak during the lockdown seem to have turned around. So it does look like these credit strategies are coming back into flavor in a big way. Already over the last 6 odd months, we are seeing the non-AAA category, the AA bonds especially, being the best performing sub-segment of the bond market. So already the markets are rewarding these non-AAA companies. And like I said, you must remember that the lessons of ILFS were it was like 2.5 years ago. So yes, we must remember those lessons, but we cannot act as if ILFS happened last month, right? So I think the environment has changed. So it is very, very advisable for investors not to look at it from the ILFS angle, but rather with a fresh pair of eyes. I think there are significant opportunities. Having said that, please be careful in evaluating risk over here. It's very, very tempting to look at the highest yield funds and or products or bonds and say that this is where I want to be. But that carries significantly higher risk as well. What you have learned over the last cycle or two, and we've been running this credit risk fund of ours for the last 6 to 7 years now, and what we've noticed is the highest yielding products are rarely the highest returning products. Meaning just because something has a higher YTM does not indicate that the future returns will be the highest. This is something to keep in mind. So please be aware of the risks you carry, and then look at this. You could also find products in the industry which are in between. So credit risk funds, by the regulatory mandate, need to invest 65% or more of their funds in bonds rated AA or below. So therefore, they are very concentrated towards the credit spectrum. But you do have products which are in between, 50-50 or other mixes, which may be more suitable than a pure credit strategy. Yeah.
But process plays a very important role, right? I mean, there are about 20, 25 funds in the country today, and to differentiate that is very, very difficult. So how do we differentiate ourselves at Access?
Yeah. So fundamentally, when you are investing in, let's take a case of a AA rated bond. So as I mentioned, a AAA rated bond is the highest quality, and a AA rated bond is in the next bucket of quality. So these bonds, let's assume that I have a portfolio of 10 AA bonds. They have a yield which is equivalent to a AA yield. Right? Let's assume I also have another portfolio where I have 50 AA bonds. So the difference is I have a portfolio of 10 AA bonds, each of 10% of my fund, totaling 100% of my portfolio. And in another portfolio, I have 50 AA bonds, each of them 2% of my portfolio, but all AA bonds nevertheless. Now, the beauty of the bond markets is the yield of these two portfolios will be similar because they are all AA bonds. But if a bond fails, as I mentioned, the credit risk is the risk that a bond will not pay you back because of bankruptcy. So if any one bond fails for you, then you're putting 10% of your money at risk in the first strategy, but only 2% of your money at risk in the second strategy. So fundamentally having a very, very, what I call aggressively diversified portfolio. So aggressive and diversified really don't work together, but I call it aggressively diversified because we really believe that we want to spread our risk in such a way that no one downgrade or default or any such event, should it occur, it should not affect any significant part of our portfolio. And this has been something which has really worked well for us through this entire cycle. And we've really not had to take significant pain on account of any credit events because we've had a very diversified portfolio. And apart from that, of course, it doesn't mean that we can just go and buy any 50 bonds out there, right? The idea is you still need to do your work, you analyze the companies and pick the bonds which you want. Maybe you don't find 50 bonds, you find 30 bonds. Fine, you find 3% each of 30 bonds. But the idea is to have a highly diversified portfolio, which I think is going to be a lot more resilient in this environment. So that's been our strategy, and I think it's worked quite well for us over the last several years.
Finally, the last few questions. There is a lot of innovation in products on the debt space with ETFs coming in and index funds. So recently, a CEO put up on our Twitter feed, there's an index fund coming on debts, and that's a novel idea. Does that work, or is that just a passing fad?
So we do not know yet how these indices will be constructed. We have a long history in India of equity indices. We have a good sense of how these indices evolve. Even within equity indices, we have seen the significant evolution in the way those indices are constructed. We used to be on the basis of market capitalization. Now it's on the basis of free float. So there are a lot of lessons learned over a period of time as to how these indices get constructed. In bond markets, unfortunately, we don't have that good a long-term track record of index construction and indices themselves in India. So we do have good track record of things like government bond indices, but especially on the corporate bonds, while some indices do exist, the methodology and the kind of characteristics of those indices have yet to fully stabilize. So I hope this creation of these products leads to better indices and more innovation in the fixed income space. I think there's an opportunity certainly for investors to look at these products, especially on the index kind of side. The ETFs, by and large, the way they are constructed have been structured as kind of open-ended FMPs. So these are roll-down ETFs by and large. So I'm treating them as a subset of the roll-down strategies, whether it's FMP or ETF or a roll-down open-ended fund. So many of the ETFs are solving for a specific target date in mind. So I think there's good value there if you have a mindset that I want to buy a fund which is let's say 2025 or 2035, whatever the maturity date, whatever the target date is, to have an idea. So then you do have a fund which meets those requirements. I would hope that there's a lot more innovation. We do need to see a lot of innovation in fixed income in India, and these are good steps. Let's see how it goes.
Yeah. So I think we're almost out of time. So just one final question: is this the right time to invest in markets, the debt markets? What's your view, Siva?
It's a very good time to be investing in debt markets.
I don't think there's a bad time.
The complaints that I've got over the last year is with inflation running at 5%, 6% or more, and FD rates or bond yields running at 3% and 4%. I'm not even able to get returns commensurate with inflation. How do I get inflation beating yields? And now finally you are. Short-term bond yields have gone above 5%. Long-term bond yields, long-term AAA bond yields have gone above 7%. AA bond yields are, let's say, well above 7%. The ability now for investors, I think, to make above inflation returns, I think, is coming back, which is the number one thing which I see possible. The second thing is, we keep talking about rising interest rates and the interest rate risk as being negative in the sense that they tend to depress bond prices. But remember, there's also a reinvestment opportunity which comes in. So what happens is that as the bond matures, it has to get reinvested. And in a rising interest rate environment, the bonds which are maturing get reinvested at higher yields than where they were in the past. So shorter duration bonds, let's say a 3-month bond or a 1-year bond, will get reinvested. The maturities or the coupons of those instruments will get reinvested at significantly higher interest rates as rates move up. And so we should see over this cycle, if RBI delivers these rate hikes that the bond market is expecting over the next maybe couple of years, that we should actually see a lot of these short duration bonds come up in terms of their yields will start rising well above the inflation rates, which is the number one thing. Finally, at the end of the day, when you're looking at investing in fixed income, the first objective is to deliver returns which are above inflation, and I think we are at the cusp of that, which for me is the most important.
Yeah, true. So great. I mean, thanks, Siva, for being very patient with us and explaining all the concepts in very good detail. As always, investors, please do write to us. Please do reach us out on the phone. You can also reach this video has been asked for to be shared and the PPT to be shared. This will all be available to you on YouTube on our channel in the next 24 hours. So stand by, and you can use this video in your analysis of what is debt and how to invest in debt. As always, we're always a phone call away. So please do reach out to us, and happy investing. Thank you so much.
Thank you, everybody. Have a good evening.